Jamie, welcome back.
Dale, good morning. Can you hear me okay?
Oh, yeah, hear you, see you.
How are you?
Uh, what's your reaction to the number?
Well, I have to confess, my screen's froze at about 8:29, so I'm only just seeing them now. It looks like PPI slightly hotter than expected and retail
Yeah,
sales a bit weaker than expected. Is that fair?
yeah, yeah. So, the book, it kind of like a bookend, but from what we had Tuesday to what we had here. So, with
Well, it
that
looks
in
like
mind,
if
go ahead.
sorry if the PPI is slightly on the hotter side, that's the third inflation reading in the last few weeks that's coming on the hot side. We had January CPI, we had
Yeah,
the February CPI slightly hotter, and now this. So if that's telling you something, I think it's that inflationary pressures are still there. They're not coming down, not easing as much as people had hoped for. Certainly those in Washington. And
yeah.
we've got a few weeks ago we had calls from the guys at Apollo saying, I think they were the first ones to say no rate cuts this year. These were the first ones to
Right.
come out with
I
an
saw
official.
that.
Made a few headlines, rightly so, because it's a bold call. But the more numbers you get like this, then the more you can see where they're coming from.
Yeah, have dot plots moved after this number?
Well, this is it, isn't it? That's what everyone's going to be looking at next week. It's the dot plots.
Yeah.
I think I'm right in saying the December dot plots still pointed towards 325 bit rate cuts this year. And that's where
Okay.
the market's obviously gravitated to, because when we had the December SEP, I think markets were discounting what 150, 160 basis points of easing this year. So they were much more aggressive than the Fed. Markets come right back into line. So I think it's all eyes on whether or not the Fed sticks with that dot plot sort of forecast. You have to say, I mean, we had Powell last week saying we're not far from cuts. I think that was his quote, not far. But as we've just been discussing, the more inflation prints you get that are slightly or any way above
So
forecast, that's going
instead
to
of
change your
seeing
thinking.
Yeah, instead of seeing the light at the end of the tunnel, he's looking at a train running down the tracks. So
Yes,
he's
I
going to
think
have to. So Jekyll and Hyde, he'll be Mr. Hyde next week.
well, to be fair to him, he can and he has done, and all Fed chairmen do, or chairpersons. They've got flexibility in their guidance and their rhetoric, and I'm sure that if he wants to employ, he wants to give themselves that bit more leeway in terms of the statement and the press conference. I'm sure he can do that, and that's within their gift to
So
to buy
10-year
themselves time.
yield over this 420 level here, Jamie, you see it? So 420 was been a very important technical pivot on the way up, on the way down, and here we are back above 420.
Yeah.
And what we didn't accomplish, maybe we're going to accomplish now, and that would be perhaps a bigger retrace of this decline in yields because we didn't even get to halfway back here, which was
Well,
439. What do you
that's
think?
exactly right. I had one of your colleagues say in the chat just past there that he thinks yields are going to grind lower. Now we're talking about inflationary pressures maybe re-accelerating, and yet I think it's not a bad call at all to think that yields can go lower here, because we've seen from one of your other colleagues, he mentioned that the options have been absorbed pretty well by the market. I think it was $117 billion this week. It was
Yeah.
$169 billion a couple of weeks ago. So we're at yields of, as you say, 420, 430, and yet the market is hoovering that up. No questions asked. And bond market volatility, I was just looking this morning before I came on, the MOVE index, low since September. So that tells you that the
Okay.
bond market is not in a panicky mode at all right now.
Would
Whether
it
it
be
be
if we go
signs of
to
issuance or data, the market seems pretty comfortable about where we are.
okay, it may move up a little bit if we retrace back down towards the 90 level and take out the Feb lows. A lot of people calling this a bullish formation, and I
What's
agree.
your range then on the 10-year yield? What range are you looking at?
Well, this is TLT, so it's more
Right.
like a long bond, the longer end of the market, which, you know, has been underperforming a 10-year. But when you look at the 10-year again, if we can maintain a close over 421, you know, why can't we make a run towards 440? That would surprise the market. That
440,
would
yeah.
be,
But where
yeah.
were we? Where were we 6 months ago? Probably about
You
440.
mean 6 months ago, we were at five.
Five. Well, there you go. So there's a lot of room to go
Yeah.
back. I,
So
I
is
think
this,
I think as your colleague said, I think once we get closer, maybe 450 and up towards the 5% level, I think demand and appetite for safe, quote unquote, safe assets, safe returns of 5%, guaranteed coupon payments, etc. I think the market is showing proving
why don't you
itself.
think this is
There's good
safe?
demand for it.
Isn't this a safe investment? It's like a bond, isn't it?
What's that,
Nvidia?
Charles? Sorry,
Nvidia?
Nvidia.
Why are you laughing? It's safe.
Well, we
It
had
only
what
goes
we
up, right? Huh?
well, it went up, but there was one day last week it came down. What about
Yeah,
peak to trough of about 10-12%?
yeah. The nice little key reversal. So you think that there might be some type of shakeout in the stock market, a little risk off coming in that will increase the appetite for bonds?
Again, as you were discussing in the last half hour, it's hard to see where the shakeout comes from in stocks. Okay, it's the market's very concentrated. There's certainly that FOMO fear pervading the market, and as you saw there, we had Nvidia wobble last week or a few days ago, and it's
Yeah,
pushed straight back up again. We're at new highs, and there doesn't seem to be much out there, whether it be data or policy, or as you were talking about, threat of nuclear war. Nothing seems to be
yeah, nothing
shaking.
because it's different this time,
Well, that's for
isn't
the
it?
ages, that discussion. I mean, obviously, there's going to be a correction, there's going to be a shakeout at some point. But is it going to be that crash, that big shakeout? I mean, even if we get a shakeout of 20, 15,
10%.
20, 10%, that
Yeah,
takes us back to where we were when? January?
yeah, that's what I mean.
So
What do
that's
you think the message is in gold, Jamie? And does Paul look at the price of gold? Does it mean anything to him?
I don't know the guy personally, but I would suspect it doesn't mean that much to him. Uh,
Okay.
um, and
How about to
gold
you?
is gold's a funny one, isn't it? Because perhaps I've missed something here, but we've got gold, we've got Bitcoin
Yeah.
rallying together,
It,
surging to all-time highs. Now, I get the inflation hedge element of that. Of course, gold, you can go back thousands of years for that. But Bitcoin is seen by its proponents as a good inflation hedge as well. So I get that. But one's ultra safe. One asset is ultra safe, or it's meant to be, and the other one is well, let's just say Bitcoin's not seen as an ultra safe asset. It's highly speculative. Um, so I'm just not quite. I think there's
so
something that I'm not quite seeing why both of them are sort of rallying in tandem.
how
I mean,
about this? How about this? Stocks higher, Bitcoin higher,
everything's
gold
higher.
exploding. Financial conditions are still too easy. Dollar weakening. Isn't that the theme running through the whole market? That
That could be the
despite higher
thread that ties it
rates,
all together. Financial conditions, yes.
yeah.
That
So
could be it. Yeah.
okay.
I mean, we had the
Um,
Goldman, I think, and the Goldman Sachs Financial Conditions Index. I know there are others out there, but the Goldman Sachs one is still. I think I haven't seen it for a few days, but it's pretty low. I think it was the
okay.
lowest since September or something last year, October last year. So conditions have eased, but then you get into that self-fulfilling spiral, don't you? When the market goes up, financial conditions ease. When yields sort of come down a bit, financial conditions ease. And when the market sees financial conditions easing, they push assets higher. So it's a
Okay.
kind of self-virtuous circle in some respects. It certainly
So
feels like that
what do you
now.
think Paul's going to say in his presser after these numbers? Um, he's not going to cut rates. Is he going to talk about us being closer how's he going to take this when just at his last his testimony before Congress said that he could see a time that's not too far away for
Well, this is
cutting
it.
rates.
It could be a message. He might have backed himself, or he might find it difficult to sort of nuance that message or to display a consistent
You could
message.
have said backed himself into a corner once again. This guy spends a lot of time in the corner.
Well, there's certainly a lot of criticism being leveled at him that he backed himself into a corner late last year when they basically gave the green light to the pivot, and the market got built up on expectations of 150 basis points cuts this year. They've obviously, I mean, to be fair to them, though, they didn't say that in the SEP forecast. They were consistent with 75 basis points. So, but they let the market run away with itself a bit. That's obviously come back in the last few weeks. As you say, in his testimony, he said I think his quote was, "We're not far. We're not far from cuts."
Okay.
However, again, as we've said, when you get producer prices, consumer price inflation, hotter than expected, rent prices, rent payments aren't coming down as quickly as they hoped. Services inflation, some of the Fed's favourite measures of inflation, some of the gauges that they look at, core measures, core, if you like, they're running hotter than expected. So are we not far from cuts, or are we a bit further than we've been led to believe? That could be a messaging and communications problem for him. But he's been in the job how long now? How many years?
I don't know,
Several
7?
years.
Yeah.
7 years. How many press conferences has he done? Quite a few. I think that challenge, I think he'll probably meet that challenge fairly well. He'll give himself enough leeway and flexibility. And,
What do you think the purpose of his appearance on 60 Minutes was for?
Well, these appearances on 60 Minutes and shows like that are for the general public, aren't they? I mean, we in the market, we parse their every word in their speeches and their remarks and their press conferences and interviews on financial television. But this 60-minute stuff is for the wider public. I have to confess, I didn't watch it all, but that's just trying to convey a message, probably to let the public know that they have the dual mandate of employment and stability. I mean, there's no doubt that inflation is still above target. We're still in a kind of cost of living crisis. Goods and groceries and everything at the stores cost more now than it did 2, 3, and certainly 4 years ago. So I suppose he's just trying to get that message across that the Fed is aware of that, he's on top of it, and that inflation.
He was trying to explain higher rates and also kind of made a statement that the Fed was going to keep their integrity and not monetizing all that fiscal stimulus is something that they're not going to do anymore.
That could be a tricky one as we go forward, as we're talking about as well. The market seems to the market seems to be absorbing all that debt coming on board. No problem so far, but as we've been saying for a long time, there might come a point where the market balks at that. My opinion is that I think when we have rates of 4-5%, I don't think there's any problem with demand and appetite for government debt. That might not always be the case, though. I think the Fed, I don't think we're going back to pre-2008 days where the Fed's imprint in the bond market was, 5-10% of the bond market. I think the Fed is going to maintain a larger footprint and share of the bond market than it did previously. It's just, I don't think we're going back to pre-2008 days. So I suppose we have to get used to it in some respects.
Yeah, a lot of people have a political argument for why the Fed will cut to try and help Biden win re-election, which makes me think, not to look political, that maybe he won't cut, especially now that he has cover with higher numbers coming in, because, he would be accused of just trying to help Biden if he started cutting rates.
But the flip side of that is if they don't cut now or June, because obviously March, he set himself March off the table. If they don't cut in June, any rate cuts that they do want to implement will be much closer to the election, and therefore they leave themselves much more exposed to that accusation of political interference. There could be an argument to make
That's a pearl,
whereby
Jamie. That's a pearl.
where they cut now, June and I don't know, July or August.
Yeah.
So that's sufficiently ahead of the election so as to keep a distance between themselves and the vote. So you can argue it both ways.
Okay. Why don't we talk about another central bank, BOJ? They've been making some noises about that, they may be normalizing, they may raise rates. The yen hit a pretty nice high here. It almost looks like it's possible the top is in the yen, kind of a big double top. Are they going to do it this time, or are they going to be like they've been like Lucy in Peanuts, that when you go to kick the ball, they pick up the football and you go flying across the field? Charlie Brown.
This is a date with destiny, isn't it?
Yeah.
It'd be the first rate hike in since 2007.
God, I was only 10 years old.
There you go. You haven't aged a bit, but yeah, 2007, and it would take us out of negative interest rates, which have been in place since 2016. So that's 8 years, 7-8 years. I think people who've been trying to second guess the Bank of Japan, or trying to guess when they're going to normalize policy. It's been a long waiting game for them, hasn't it, over the years? There's certainly a head of steam is building up. There's no question about that. You and your colleagues were discussing the wage negotiations in Japan.
Right.
Toyota given the biggest pay increases in 25 years. We get this survey data on wage talks tomorrow from the Labour Union, which sources have told us in Tokyo that could be what tips the balance for the Bank of Japan. If that comes in fairly positive, i.e. strong, showing that wage growth is sustainable and in place, and that could be the green light for the Bank of Japan to move in March.
Can you remember in your career, Jamie, any time period where labor has had so much leverage to garner these kind of wage increases ever?
Absolutely not. No, absolutely not. And I've only been covering this stuff for 25 years, 26 years. So we're talking about the mid to late 90s onwards. I don't think labor and workers' pay and influence in wage talks has had any impact, any bearing in that time. I mean, the 60s, 70s, and 80s perhaps, but certainly not since the mid 90s, not at all. But that's just a consequence, obviously, of the pandemic, the inflation burst that we saw, and we are where we are. It's an interesting contrast to make, though, between Japan and, say, the Eurozone. Just say, for example, that Toyota pay award of well, actually, to be fair, we don't know the actual percentage increase, but say for argument's sake it was 5%. So the Toyota are giving the workers 5% pay rise. I think in Japan that would be seen as a kind of that would be seen as a virtuous wage price spiral, which could force the Bank of Japan to normalise policy. However, if you get 5% wage rises in the Eurozone, oh no, got to be careful, that's a dangerous wage price spiral. So, I mean, but it's the same number.
Yeah. Oh, so basically that's not happening in Europe. So, I mean, people have gotten 20, 30, 40% pay raises here in the US.
40%? I'm in the wrong job.
Yeah, I said that too. Jamie, anyway,
who's getting 40%? Who's getting 40%?
Some of the wages for the auto workers over the course of years. I mean, I can't ever remember a time when actors actually had any leverage with the studios. They would have to break I mean, it's everywhere. So,
but yet we're seeing. I mean, we're talking about some of the CPI and PPI prints being, that much, a tiny bit higher than expected. take a look at inflation-linked bonds, tips, break-evens for 10 years, 5, 10, right out years and further out the curve. Can you see any sort of sense of panic in these markets? I
So they're
don't.
talking about credit spreads being as tight as they've
Yep.
been in decades.
Yep.
No one sees any risk out there. But
Well,
these,
we're discussing that risk, and I think people are aware of it. But is there any catalyst that's going to trigger a shift from where we are now in this kind of I hate to use the expression, but this Goldilocks kind of world of things seem to be rolling along fairly smoothly. Unemployment's still quite low. Debt serviceability, is okay on a corporate level and even on a household level. People are feeling asset rich. Corporates, the big ones anyway, have a lot of cash in the bank. So, is there anything that's going to trigger a shift out of that kind of scenario into something where we are much more concerned, like instantly concerned about inflation risks? And we're not seeing it in the bond market. We're not seeing it in the credit market. We're not seeing it in volatility. We're just not seeing it yet.
yeah.
That's not to say it can happen, but right now, why would you want to go against it?
Yeah. Because there are times when contrarians are right, but they could be broke before they are.
What was it?
And that's why
Keynes said the
what's
market
that?
can stay. What was it? Keynes
Oh
said
yeah.
the
The
market can
market has stayed
stay,
solvent longer than me.
or something like that. Yeah,
The market always
can be
wins,
irrational
Mr.
as
Market.
long. Yes. So
Yeah.
the market may always be right, but as one of your guests was also pointing out earlier, timing is everything.
Okay. So
And right now, it's hard to see. It's hard to see what's going to, flip that switch.
how about a chaotic election or something like that in the
Oh,
US? There are
absolutely,
elections all
absolutely.
over. Yeah, and we're not that far away. It's only, 7 months away. That flies by.
Absolutely. No,
Um,
no. I think that risk, the risk of whatever you want to call it around the November election is certainly a factor, and that could concentrate people's minds. But 7 months away, as you say, will fly by. But there's a lot of data in between now and then. There's a lot of policy decisions, a lot of earnings. There's stuff in the here and now, well before that, which the
does,
market will probably
does
trade off.
does Reuters do a poll? Do they do polls on presidential polls? If
Yeah,
so, what are they showing?
I haven't seen our last ones, but the ones I did see this week is that Biden's kind of pulling ahead 2 or 3 percentage points. I mean, it's a very small margin, and it's probably within the margin of error. But on a sort of broad base of national polls, I think it was can't remember what publication I saw it, but they aggregated some of the consistent polls over the last few weeks, and Biden's pulling ahead, but it's a very small amount, 2 or 3 percentage points. That
Okay,
can change in a day.
if he gets reelected, there is going to be tax time. Raising capital gain tax, raising corporate taxes, saying, anyone making more than 400K.
Could be, yeah.
Could that be something that's a pretty big fundamental change? If your capital gains go to 50%, it makes speculating in the market not as,
Yeah.
you know, uh, not the greatest risk to take if you have
I
to
don't think
give
that
half
I
of it
don't think the
back.
markets will like that one bit, but that could be difficult to push through both houses, of course, and we have
I
to
hope
wait and
so.
see.
Okay.
On the other hand, you could argue that if Trump gets in, he's more committed to, if you like, America first, onshoring. There could be more of a trade war, tensions with China, and certainly in terms of trade, could ratchet up. And all else equal, you could argue that could be inflationary. So we could get inflation re-accelerating, or inflation expectations re-accelerating. So,
Yeah.
there's arguments on both sides, certainly. But
Yeah.
I think given the relative calm in terms of market volatility that we're seeing right now, and some of the spreads that we're talking about being the tightest in years, the election is a risk, but it's over the hill slightly. And 7 months is, down the track a bit. I think once we get closer to it, you'll start to see that filter into market pricing, but we're not seeing it now.
Well, Jamie, you're far from over the hill. Okay,
Don't feel like it.
keep up your great work at Reuters, Jamie, and the best place for people to follow you on X at Reuters, Jamie.
That's the one.
Do you field questions when people send you, DMs or something like that?
No, absolutely, absolutely. I'm happy to engage with anyone who wants to get in touch. I'm a bit less
Okay,
active on it these days than I was in years gone by. I think that probably applies to most people.
yeah.
But yeah, certainly, always
Yeah,
happy to engage.
that's pretty amazing to just be able to send Jamie a question and have a guy like him answer it. So, thanks for your giving spirit and for coming here over the last few years, Jamie, and edifying our community. I hope this year is a great one for you.
It is
And
absolutely, it's fantastic. Always happy to
yeah,
come on and please ask me back.
thanks for letting me interrupt you today at least 20 times. And we just keep moving on, and really very interesting about if they're going to do it, they have to do it now to not look by June, to not look political. I think that's a pearl. That's an article.
Yeah. Well, let's see what they say next week. That could be one to watch.
Okay, Jamie McGeever.
Dot plots next week. Dot plots
Oh,
and the long run neutral rate. Those are the ones to watch.
okay, I think they'll use some whiteout on a dot or two.
Yeah.
I guess
The
that's what I
neutral
do.
rate could be revised higher as well, slightly higher.
Yeah,
Now, these things get a bit wonky. Some people dismiss the idea, the whole concept of the neutral rate or the long run R star, etc. But the policymakers do look at it, and if they do, markets probably should too. So that could be one to watch.
all right. Thanks so much, Jamie. I'll talk to you
Thank you,
in
Dale.
late spring, early
Look forward to
summer.
it. Look
All
forward to
right,
it.
buddy.
Take care. All the
Jamie
best.
McGeever, everybody, follow him. You could tell we covered a broad range of topics, and he's willing to, if you have a question about anything in the financial markets, especially what's happening with the Fed, shoot Jamie a message. And that's going to be a wrap for me and Face. Thanks for being here, everyone. Hope we gave you an edge. Don't just count your pips, count your blessings. And join the team in 15 minutes for the morning edge. And I'll see you guys tomorrow. And that'll wrap up the week tomorrow. Yeah. Okay, cool. All right, Jamie, take it easy, buddy.
You too, Dale. All the
See
best.
everybody.
Bye bye.
People are thanking you, Jamie.
Well, thanks to them. Thanks for watching. And
All
I hope
right.
some of it made sense at least.
98% did.
I'll take that all day long.
All right, buddy. Thank you.
See ya. Bye-bye.
See ya.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.